Hey, Adam Hooksema here from ProjectionHub, and in this video, I'm going to be walking you through how to sell your small business to a buyer who is using an SBA loan. And the reason I'm focused on an SBA buyer here is because for most small businesses in America, if you're valued at less than $5 million, the business you're selling is less than $5 million, then the buyer is likely going to be considering an SBA loan as a way to fund the acquisition. So SBA loans can be used for deals up to $5 million, and in some cases you could go larger than that, but we're going to focus on kind of $5 million and less. And I'm going to help you kind of think through, as a potential seller, how would an SBA lender look at your deal? And we're going to help reverse engineer the SBA lender's process to help you kind of calculate a realistic sales price and understand how that process and structure is going to work. So before we dive too deep into the details here, just a little bit of my background. My name's Adam Hooksema. I own a company called ProjectionHub, and prior to ProjectionHub, I was an SBA lender myself for 12 years, closed about 1,500 loans, and I started ProjectionHub on the side as a side hustle while I was a lender myself, and then a few years ago stepped out of that lender role to focus on ProjectionHub full time. Here's a picture of me with the Indiana State Director of the SBA winning an SBA award for Mission Lender of the Year several years ago. So I have a lot of SBA experience, and then also now as the owner of ProjectionHub, what we do is help a lot of buyers, business buyers, prepare projections and business plans and ultimately walk through the SBA process. So we help them find a lender who could be a good fit for them, help them through that process. And so based on seeing a lot of acquisition deals, I wanted to share for the seller's perspective. I want to help you as a seller understand what this is going to look like, what the process typically looks like, and kind of put on my SBA lender hat and help you think through okay, how do I prepare my business well to sell to an SBA buyer? So what we're going to cover today, kind of part one, is just understanding who the typical buyer is, who's actually buying small businesses, and how do they determine what they can afford. Part two, looking at SBA acquisition loans, why they matter, how they're structured. Part three is calculating a realistic sales price. And then part four is how to arrive at a desired sales price, what levers you can pull, and kind of preparing your business to be able to get you to a number that you need to, either retire or, meet your financial goals. So here's the truth about pricing when you're looking to sell a business. It's not actually you who sets the price when you sell your business. And that might sound really frustrating and annoying, but honestly, from my perspective, it's the buyer's lender. The buyer's lender is going to be the one who is ultimately saying hey, this is the most that we can lend on this deal based on the cash flow of the business. So that they're going to look at your financials, your tax returns, and your cash flow, and that's what's going to determine what the bank will actually fund. So if your asking price is significantly higher, something's got to give. Maybe if you're lucky as a seller, the buyer can bring in other equity, other investors, or they have more cash savings of their own, and maybe they can pay a higher price. But the lender's loan amount is basically going to be what it is. It can't go higher even if you want a higher asking price. All right, so let's just talk through, who your likely buyer is. Who's buying small businesses these days? Well, I see a lot of key employee and partner buyouts. So key employee who really already knows the business. SBA lenders love these types of deals because there's an understanding of the business. There's just a lot of less risk. Now, the downside of the key employee is a lot of times if they're an employee, they probably don't have a ton of cash laying around, a ton of savings. They're not just going to write you a check for $3 million and buy the business, right? They're probably going to need to get a loan, and they might have trouble even coming up with the 10% down payment that the SBA requires. Individual acquirers and career changers. So sometimes you've got, corporate folks or MBAs who decide, hey, I want to get out of the corporate rat race and I'm going to buy a small business and I want to own something on my own. Search funds and independent sponsors. These are for, kind of the higher businesses in terms of sales price and enterprise value, probably getting close to that $5 million purchase price and above. And then competitors and industry kind of roll-up consolidators. So there's a lot of organizations that are, and this could be private equity groups, but investor groups that are saying, hey, we want to buy up a whole bunch of pest control businesses and roll them up into one big pest control entity and sell that, right? at a higher multiple because we're so much bigger. The common thread though is that most of these businesses aren't going to have the cash just laying around to buy your business outright. And even if they did have the cash, a lot of times they don't want to spend all their cash, or they don't want to put all that cash in as equity. They might want to leverage that with an SBA loan. So most buyers have, in general, let's just say they have high sweat equity and low cash equity. So the way that the old way, we're calling it here, but in the past, you might have had to do seller financing for the whole thing. So you sell the business to an employee, perhaps, and you just say, okay, you're going to pay me back out of the business profits over the next 5 to 10 years. And you as the seller, you really carry all the risk. If the buyer screws things up and cash flow diminishes, like you may not get paid in year 7, 8, and 9, right? You're still emotionally tied to the business. If they fail, you might not get paid everything that you're owed. So SBA financing comes in and says, hey, we can help you get 80 to maybe 100% cash at closing. So as the seller, you're going to get paid most of the purchase price right up front at closing. The bank is taking most of the risk, but really the buyer and the bank are taking the risk there. And the buyer might get equity from their own savings, from outside investors, or also potentially a small seller note. So you may have a seller note that is, not anywhere close to 100% seller financing, but a small seller note where they continue to pay you over time. And that allows you to, fully transition out of the business. So why this matters to you as a seller is that the SBA lender is really going to determine the price, right? And so 80% of small business acquisitions that are under $5 million involve SBA financing. And the SBA lender's underwriting process is effectively going to determine your sale price. So if you can understand their process, then that's going to help you understand what price you can expect. And there's not really a good way to just negotiate with the bank, right? They're just going to say it's a mathematical thing. This is what we're able to do. And so we need to reverse engineer that and see, how do I get my business to be cash flowing and performing at a level that allows me to get the purchase price that I want? So who's this for and who isn't it for? If you're thinking about selling in the next 1 to 5 years, if your business is likely valued under $5 million and you want to understand realistic price before going to market, this is a good fit for you. If your business is 10 million in revenue or greater than 10 million in enterprise value, it's probably not going to be super relevant for you. And, if you want a step-by-step guide to selling the business, that's not really what I'm focused on here either. And so really this is understanding the SBA structure and how the math all works out. So let's dive into a deeper dive on understanding SBA acquisition loans and why the structure and pricing and all of that is so important to you as a seller. Here's how the SBA typically structures deals. The bank is going to provide 80 to 90% of the purchase price. The SBA is going to guarantee 75 to 85% of the bank loan. So what this does is it reduces the bank's risk, right? So the SBA, the federal government, is going to come and guarantee and reimburse the bank 75 to 85% of the loan. So it allows the bank to take a little more risk than they would otherwise. The buyer is going to bring a down payment of 5 to 10% typically as a bare minimum. So the SBA is going to require 10% equity injection as a minimum, but it is possible to do 5% as equity as the buyer and 5% as a seller note on full standby, which we'll get into in a moment. All right, so here's what a typical deal looks like. Let's say it's $1 million purchase. You're going to get $900,000 from an SBA 7A loan, 90% financing, a 5% seller note, and then a 5% cash equity injection from the buyer. Now, the other thing you need to consider here is that if you've got $1 million purchase price, there is loan closing costs, SBA guarantee fees, you're going to need some working capital. So probably in reality, what this looks like, if it's $1 million purchase price, it might be that the SBA loan is $1 million. And then you've got an extra $100,000 roughly on top of that helps provide working capital. It provides the closing pays for the closing costs and that sort of thing. So just keep that in mind as you think about structuring structuring a deal. But what this allows you to do is you're going to walk away with 95% of the purchase price paid, the day of closing. Now, it is possible that, you do a larger seller note. I'm giving you the example of kind of what's relatively typical. If you're going to have a seller note at all, at minimum, it'd probably be 5%. But some deals have seller notes with 20% or 25. And maybe that's because that's the only way the deal can get done. Maybe that's the only way the bank feels comfortable, where they want the seller to provide a larger seller note. And that could be because maybe there's not enough collateral. Maybe the business has been declining over the years. Maybe the purchase price is just a little too aggressive. It doesn't value out for the bank. So the bank is going to hire a third-party independent valuation company to do an appraisal of the business. And this is an SBA requirement. And if the valuation comes in at $1 million and you want a purchase price of 1.2, it's possible that the lender would say, okay, you can still sell it for 1.2, but you got to do that extra 200,000 is going to be a seller note. So the SBA loan can only be at a maximum of whatever the business appraises for. Okay, so how does a small seller note make a deal possible? Especially I see this a lot in employee buyouts. So a lot of times the employee just isn't likely going to have a whole bunch of savings sitting around. And so what we often see is the employee buyer brings 5% of the purchase price. So in our $1 million example, they bring $50,000, and then you carry a $50,000 seller note. And if you put it on full standby, so that means the buyer can't make any payments on this until the SBA loan is paid off. So, that is a downside, right? They're not allowed to make any payments on it until the SBA loan is paid off. But what that allows the buyer to do is use that $50,000 seller note here as equity in the deal. It gets to count as equity if it's on full standby. And remember, the buyer needs to bring 10% equity to the transaction in total, but 5%, half of it could come from you as a seller on a seller note on full standby. So this is a way to, especially if you're trying to help out an employee, a longtime employee who you're selling to, it's a way to get deals done. You're going to hold on to that, seller note, and you'll get paid eventually on that. You can accrue interest on it, but you just can't pay, the buyer can't pay on it until the SBA is paid off. Okay, so your buyer has to bring cash to the table though. There's not any 0% financing acquisitions unless you're acquiring a business in the same industry that you're already in. But this is not really what we're talking about here today. So just in almost every case, 10% equity injection is going to be required. And so where does a buyer get that? They, personal savings, they can do a 401k rollover. It's called a ROBS. They might have a home equity line of credit or a cash out refinance on their home. Maybe a family gift where it's got to be documented as a gift, right? So they'll require a gift letter. What they don't want happening is you actually get a loan from your brother and, you got to pay that back. They don't want to treat that as equity. It's got to be a gift to count as equity. And then your seller note on standby. And then of course, you could have outside investors. You could always bring in outside investors. But why this matters to you is if your buyer can't bring the capital, the deal isn't going to happen. So a lot of times we work with sellers and they've got a buyer identified, they've got an employee maybe, or somebody that they would like to sell the business to. And then they get too far down the path before realizing this buyer doesn't have the cash. They don't have the cash to be able to do it. So it's kind of an awkward conversation, but you really need to have this conversation pretty early if you as the seller are identifying the buyer, you need to understand, do they have the cash for down payment? If not, then it's just not going to work. Okay. So get that understanding before you get too far down the path. So the documents that you're going to need as a seller to kind of determine your price. It's the last 3 years of business tax returns. If you have accounts receivable and accounts payable, you have aging reports that can be useful, equipment and asset lists, a year-to-date profit and loss and balance sheet, a customer concentration list, usually the top 10 customers or so by a percentage of revenue, and then a current debt schedule. So these are things that, you should start gathering now. And these are, I'll take a quick pause here. If you pull these documents together, and you want us, our team, to do a quick review and just give you a high level, like, hey, what do we think this could qualify for in terms of SBA financing? Feel free to reach out to us directly. support@projectionhub.com is the email address. You can reach out and we'd be happy to have a conversation with you and kind of talk you through that. But, at the very least, the last 3 years of business tax returns are kind of the key bare minimum thing you need. So you can always start with that. And then, these other documents could have an impact, but business tax returns are the main thing that the lender is going to use to determine your historical cash flow. So when a lender opens your file and looks at your finances, what are they going to be looking at? They want to see, is the revenue stable or growing over the 3-year trend? Does the cash flow support the loan payment? So this is DSCR, debt service coverage ratio. And this is a calculation. Basically, think about it like this. You've got, based on the proposed loan amount, you're going to have a proposed annual loan payment. Let's say the loan payments add up to $100,000 for the year. They want you to have $125,000 of cash flow for every $100,000 of loan payments. So they want you to have a debt service coverage ratio of 1.25 or above. That's the typical rule of thumb. And so this is really going to be what determines a calculation. Now, one thing that is important for that debt service coverage ratio calculation is we're assuming an SBA loan on a 10-year term. That's a typical term for an acquisition loan. If the buyer's acquiring real estate, that can lengthen the term of the loan. And if that lengthens the term of the loan, it lowers your annual debt service, which means the exact same business could borrow more, the same amount of cash flow, but could borrow more if real estate's included because they can amortize the loan over a longer period of time. They're going to look at seller's discretionary earnings. You may have heard that buzzword, SDE. Now, a lot of times, sellers want to sell the business for a multiple of SDE. And then what they often forget is that the buyer is going to also need to take a salary, right? They need to get paid. And so it's going to be SDE minus what the buyer is going to need to pay themselves. That's what ends up being available cash flow to make loan payments. So your SDE is not actually what's available to make loan payments. It's SDE minus what the buyer is going to need to get paid. And then they're going to look to see if the tax returns match what you're claiming on your SIM or your financial statements from QuickBooks. If there's big differences, that's going to be red flag. And then is there customer concentration risk? Do you have one big customer that represents 50% of the business? Those are going to be, concerns for a lender. All right. So that's kind of SBA at a high level. We're now getting to how do we actually calculate a realistic sales price. We're going to be really showing the math of how a lender is going to run the numbers here and determine what they think they can lend against a business. So to start with, it all starts with your tax returns. Your tax returns are what drive underwriting. That's what the lender is going to use. It's not your QuickBooks profit and loss. It's not your own spreadsheet calculation. It's not, what you tell the seller, well, here's what I actually make, but here's what I show on my tax return. It's what's on your tax return. That's what you start with. And so this is where, if you have some really aggressive tax strategies that can backfire a little bit, particularly when we say aggressive tax strategies. I mean, if you're maximizing first year depreciation or accelerated depreciation, that's not necessarily going to backfire. What's going to backfire is, hey, I'm accepting cash and I'm not reporting the cash on my cash sales on my tax return. That's what is going to matter here. So we also look at trend lines. So if there is a decline in revenue, especially a multi-year decline, that's going to be a major red flag to a lender, and you're going to have a whole lot of explaining to do. Now, it's not impossible to overcome this. There could be good reasons. So a couple situations where I've had sellers who, are still able to get a deal done and sell their business with an SBA buyer with multi-year declines in revenue have been situations where there's a clear health issue. So I've had a UPS store acquisition where it was a husband and wife that owned the business. The husband passed away and, it'd been a couple years and declining revenue, but it's very clear to see this had been a stable business. Husband passes away. and it's been declining since. A similar situation where a small manufacturing business, the owner was 87 years old, and you can just imagine that makes some sense that from years 85 to 87, you're slowing down. There's some decline, but the core business was still intact, and so a buyer with a strong plan was able to convince a lender to say, hey, we're going to turn this around, and there's a reason for the decline. So to determine whether the deal is bankable, you're going to be looking at cash flow. You're going to be looking at the tax returns versus their reality. But the tax return is going to take priority, and then the trend lines. So there is something called seller's discretionary earnings, SDE, which is often what sellers will use to determine a multiple. So they'll calculate their SDE and then apply a multiple to come up with the price. So the way that you calculate SDE typically would be the net profit on the tax return plus any owner compensation, if the owner compensation was an expense on the tax return, plus interest, plus depreciation and amortization, plus any owner perks like retirement, or maybe the owner's vehicle, or the owner's health insurance, life insurance, those sorts of things, retirement. So you add all of that back to try to calculate the true cash benefit to an owner. And then typically once you calculate that, typical multiples for small businesses are 2 to 4 times. So if you had 225,000 SDE times a 3x multiple, you got a purchase price of $675. So that's one angle of how you can come up with a price. And that's really the angle that a lot of times the seller will use. A lot of times the business brokers will use SDE and an industry multiple to come up with a valuation. The lender's going to look at it a little bit differently though. So the way the lenders are going to look at this, they're going to take your taxable income, and then they're going to either accept or not accept proposed add backs. So the add backs that can be effectively added to the cash flow that's available for making loan payments would be owner's salary and benefits. Again, this is an important nuance, and this might go over some folks' heads, but it is actually really important. You can add back the owner's salary if the salary was listed as an expense on the tax return. So a lot of tax returns will have like an owner's compensation line that will list what the owner was paid, or maybe they're just showing up in a salaries line item, but the owner needs to be in the expenses on the tax return in order for that to be added back. If they're not there, that's okay. It could just be that you're taking owner's draws. But if you're taking owner's draws out of profit, so let's say you had $200,000 of profit and you took a $100,000 owner draw, and it doesn't show up as an expense, you can't add that back also, right? You're double dipping. So you can only add back an expense that has been expensed in the first place. So I don't know if you have questions about that. I can certainly help take a look at your tax returns, your business tax returns, and help you kind of identify, is this an allowable add back or not? Personal vehicle expenses that are paid through the business, depreciation, one-time legal or consulting fees. Sometimes discretionary travel expenses could be added back if you can document them well. The things that will get pushed back, anything that's undocumented. Hey, I received 20% of our sales in cash and I just pocket that. That's not going to fly. Expenses that would need to be replaced. So this would be, if you said, hey, here's an expense that we have, it's going to go away after the sale, but then the new owner is like, no, we're going to still need that, that marketing. We're still going to need that position. Even if that person leaves, we're still going to need that. So we're going to have to rehire for that. So we can't add it back. And then just anything that inflates earnings beyond reality. All right. So when we're calculating SDE kind of line by line here, it's the net profit on the tax return, and then adding back the owner's salary, the owner's health insurance or personal vehicle depreciation. So this would be a good, clean example of how you could get to a 235,000 SDE with, probably add backs that the lender is going to be willing to accept. So to 3x multiple, 235 times 3, or a 705 price point, right? All right, so let's see what drives the multiple higher or lower. The multiples for small businesses are, impacted by a number of things: consistent growing revenue, a diversified customer base, owner that is replaceable. If the owner is like in there doing the work day to day, every day, working 80 hours a week, that's going to get a lower multiple because it's hard to replace. Any recurring or contracted revenue earns you a higher multiple. Also, just higher revenue businesses in general, or higher profit businesses in general, demand higher multiples. So a business that has $1 million of revenue is going to have a lower multiple than a business that has $5 million in revenue, all else being equal. Things that pull the multiple down towards the 2.5 range: declining or volatile revenue, heavy owner dependence, customer vendor concentration. So when you have one customer that represents a significant portion of revenue, and then just, industry headwinds, if there's just challenges in the industry in general. I've seen this with some franchises where there have been some franchises that got really hot, had explosive growth, and now someone's coming in to buy a franchise unit, but the industry is, declining. Maybe it's coming back down to some normalized level. That's going to get you a lower multiple as well. Okay, so there's the SDE and the multiple of SDE to determine a valuation, but that's not actually what the lender is going to use to determine what they would be able to lend. They're going to use the cash flow that's available to support loan payments, and they calculate that by this phrase, debt service coverage ratio, DSCR. And so the way to think about this: for every $1 in loan payments, the business must generate $1.25 in cash flow that's available for debt service. Now, I say 1.25 is the rule of thumb. Technically, the SBA allows you to go down to 1.15, and technically you could acquire a business that has DSCR less than 1.15, and then use projections. The buyer could use projections going forward to say, here's how we get the business up to 1.15 or 1.25 in a pretty quick turnaround. That is technically possible, but hard to get approved. So if we do the math here, let's say we had this SDE of $235,000, right? But the new owner is going to need to take a salary out of the business themselves, right? So they're going to take $80,000, let's say. That's what they need to live on. And honestly, this number, the new owner salary, is going to be, again, calculated by the bank. They're going to look at your buyer's situation, and they're going to say, based on their debt, based on their family size and expenses and overhead as a family, we think they need to pay themselves $100,000 to meet their obligations. Or, you have a single young person that, rents a small apartment. Maybe they need $50,000 a year. Maybe that's all they need. And so this is a moving target and can be different between buyer to buyer, which, that's something important for you to know as a seller, that this impacts the amount of money that your buyer needs as a salary, impacts ultimately how much of a purchase price you're going to get, which might feel a little bit strange to say, but it's true. So you could have the exact same business and you could have 10 different buyers, and the 10 different buyers could all be able to get a different loan amount based on their individual circumstances. It's not only based on the business. Okay, so what this does, 235 minus 80 gives us a cash available per year for loan payments. So we have $155,000 a year available to make loan payments, and we can divide that by 12 to come up with our monthly number, and we can back into a loan amount. So a loan at $700,000 at 10.5% interest over a 10-year term gives us a $9,450 per month payment. Our annual payments of $113. So if we now take $155, which is the cash flow available for debt service, divided by the proposed debt service of $113,400, that's a 1.37 debt service coverage ratio. So that passes the test. That's above the 1.25 number. And now a lot of lenders are going to want you to pass that test every year for the last 3 years a lot of times. Or if you missed 1 year, the farther back that you missed, the better. So if you had like 2 years in a row, you met it, but the most recent year you didn't, that's going to be an issue. If you were at a 1.2 debt service coverage ratio 3 years ago, and then the most recent years were at 1.4 and 1.5, you're probably going to be fine. All right, so what happens when the numbers don't match? So what if the SDE multiple says, hey, we think the business is worth $700,000, but the way the bank is, calculating the debt service coverage ratio says that you can only afford $600,000. In that scenario, the bank's going to win. Okay, that the lender, this is kind of like the limit. Now, what can you do if the bank says, hey, we can only lend $600,000, or it only supports a $600,000 loan, but we want to sell for $750,000 or $800,000. Well, you can make your buyer come up with more equity. So they need to put in more of their own savings. They need to raise money from investors. They need to get gifts from friends and family. Somehow they need to come up with extra cash to fill the gap. Or you could do a seller note to help fill a gap, or some combination thereof. So a couple things about setting the price. There's some things to be aware of. If you agree with the buyer on a friendly price of $1.2 million, but the bank has to do an appraisal and it comes in and it says it's worth $900,000, you're probably in a situation where the deal just dies. What I would suggest to you as either a buyer or a seller is start with we say third-party valuation. I mean, this can be at a really high level. Reach out to us. Email support@projectionhub.com. If we have 3 years of tax returns, we can get that into a spreadsheet real quick. We can calculate the historic debt service coverage ratio and tell you, hey, here's about how much, you're likely going to be able to borrow on this, and, understand a price, at least a price range from an SBA perspective. So, what you want to make sure that you do is that you don't really land too hard on a purchase price before you've really had a lender take a look at it, or even an appraisal. I mean, there are lots of different ways to appraise and value a business. And so I think from my perspective, if the buyer's going to be using SBA, you really want to look at this from a debt service coverage ratio perspective, not from a multiple of earnings type of valuation. So the SBA will require the lender to hire a third-party independent appraisal on any acquisition for loans over $250,000. And this is not someone that you get to select. They're going to select the appraisal. And, that appraisal is going to come back and it may come in lower than, what you have agreed upon a price. And so again, that's where, when that happens, the SBA lender can only lend up to the amount of the appraised value. So if there's a gap there, you got to make up for it with seller notes. You got to make up with it for extra equity injection, extra investment, or lowering the purchase price. The cost and just the timing of when this appraisal typically happens. So usually what happens is you go through underwriting. The buyer is going to go through underwriting. The deal is going to get approved by the SBA lender. And then after that, they're going to order the appraisal. So this really can be kind of like one of the last things, and it can really throw things for a loop sometimes. But you don't want to spend on an appraisal because it costs, you can see here, maybe $3,000 to $10,000, depending on, the size and complexity of the business. But you don't want to pay for that if the loan's not going to get approved. So that's why lenders typically just wait to order the appraisal until you have a full commitment from the lender, a full approval, and then you move into the appraisal process. But that does sometimes create last minute surprises where, the appraisal came back in too low. Even though the lender approved a loan of $1 million based on the appraisal at $900,000, now they have to lower their loan amount. All right, so let's just kind of talk through how we arrive at a desired sales price. So now that you know how the calculations work and how to kind of influence those numbers, let's try to figure out how are we going to hit this sales price that we want. So let's say we want to sell for $1 million. So the math there, if we're going to be able to get a multiple of SDE at 3, then we need $333,000 of seller's discretionary earnings. At a 2.5x multiple, you need $400,000 in order to sell for $1 million. So that's what the SDE math is going to say. On the DSCR method, to get to a $1 million SBA loan at 10% a 10-year term, you need $13,500 per month in loan payments there. That would be a $13,500 per month loan payment. So you need $16,875 per month in available cash flow, or $202,000 per year. So in this case, you can actually see that the math to get there on the SBA loan here is easier it's only 202,000 of cash flow, whereas this SDE of 333 is higher. Now that is because we're at a relatively low multiple. Now, if you go to a 4x multiple or 5x multiple, now that's where the lender math starts to stop working. It may not cash flow in the DSCR calculation if you're at a 5x multiple. So what are the levers that you can pull to try to, increase your purchase price? Increase revenue. Growing the business is going to get you higher multiples. Improving margins, reducing discretionary add backs. So just, if you're spending a whole bunch of money on personal expenses and trying to reduce your tax burden that way, clean that up. A few years in advance of selling is ideal. So if you know you might want to sell in a couple years, start cleaning this up right away. And if you, again, have questions or need help on like, what do I mean by cleaning that up? Happy to have a conversation about that. You want to strengthen your cash flow consistency. So anything you can do to get recurring revenue, diversifying your customer base. You don't want one customer to represent, 50% of the business. That's really going to hurt your multiple and even just ability to get bank financing too. Banks typically will struggle to approve a loan when, you've got one customer making up, 50% of the business or something like that. Make yourself replaceable as the owner. Document systems, build a leadership team if you can. And, you really want to avoid this tax minimization trap. So a lot of times you say, we're going to save money on taxes. We're going to reduce our taxes by, having these extra personal expenses run through the business or not share our revenue or whatever that might be. So if you show $30,000 less in profit, that's going to save you just some percentage. You don't pay the full $30,000 in taxes, right? So you could save some taxes by reducing your $30,000 profit, but you end up, remember that SDE is multiplied. So that $30,000 in lower profit that you showed is going to be multiplied by 3 probably. So it's going to end up reducing your sale price by $90,000. So when you reduce your profit here, let's say you pay a third of your profit goes out the door in taxes. So if you reduce your profit by $30,000, you're really saving like $10,000 in taxes roughly. And but you're reducing your ultimate sale price by 90 grand. So be careful with that. So if you're a couple years out from being ready to sell, you want to get audit ready. I mean, you're not actually going to need to get audited most likely, but the buyer might hire a quality of earnings report. And this is kind of like a mini audit. So this again typically happens somewhere in the underwriting process, somewhere in the due diligence process, where the buyer's deciding, hey, let me dive into the financials here and determine whether I really want to buy this business. So anything you can do to get ready for that, taking out personal expenses from the business, ensuring the internal QuickBooks, financial statements are matching what you actually have on the tax return. If you've got any outstanding tax issues, liens, legal matters, legal disputes, you want to get those resolved. And you want to get a good CPA involved earlier. I would say both a good bookkeeper that is going to just be doing the bookkeeping appropriately and in a clean way that is going to be easy to defend. And you also want to have a good tax accountant, typically a CPA probably. So I would really encourage you to do that. If you're doing your own bookkeeping and if you're doing your own filing your own taxes, or you're just going to kind of the local H&R Block or something to get the taxes done, I would say it's time to up level that if you haven't. And again, feel free to reach out. I have plenty of recommendations on good bookkeepers and CPAs to help through that process and just help you get ready. I've hit on these, but just to reiterate, things to do to get ready for selling. You want to start diversifying away from customer concentration now. You want to document and delegate so that the business isn't so dependent on you as the owner. You also want to avoid, it's not just customer concentration, it's vendor concentration as well. So if you have a supplier that you really rely on, and they're the only supplier that supplies this critical component to what you do, that can be big major risk as well. That vendor may kind of almost control you, right? Like if they stop supplying to you, your business is dead in the water. That's going to be something that lenders look at very closely. Okay, and then this, this is one of the biggest takeaways. You don't coast. You run through the finish line, sprint through the finish line. If you ever ran track or cross country or something, it's like, or played football, the last 5 yards, you don't relax. You've got to push through to the finish line. And this is what's really hard, because I think a lot of times sellers, by the time they've decided that they are interested in selling, they're tired. Like they're already tired, and they're already letting up. They're wanting to relax. They're wanting to coast. But boy, what happens is, when you start seeing the downward trend, it almost can make a business that was a really solid business and sellable become unsellable. Just because you're coasting. The buyer and the lender, they don't know for sure if you're coasting. They don't know if you're just coasting and slowing down, and that's the reason why the business is declining, or is something wrong with the business, and maybe I just don't want to buy this business at all because, hey, you've been dropping revenue 10, 15%, per year. I've seen this so many times, talked to lots of sellers, and it's like, man, if you would have sold 2 years ago, you would have gotten double the price, for this. But because you really want to go out on top, right? You hear that in sports, like go out on top. That's really important, I think, for sellers. So if you're like, man, in 5 years, I don't want to be doing this anymore, you really should start now, have the conversation now, so that you take the next couple of years, make sure that you're on the uptrend still, and then start the sale process at that point when you're on the uptrend, not coasting down to the finish line. So I was already kind of talking about this, but the timeline here, when you're 5 years out, what I would suggest is just do an initial calculation on your SDE, your seller's discretionary earnings, so you have an understanding of like, hey, roughly what could I sell this for? Shift your tax strategy. Don't be trying to get every deduction. You want to show a profitable business, because that's what buyers want, and diversifying your customers. When you're a few years out, clean up the books. It's the last 3 years of tax returns the lender and the buyers are going to be really focused on. So that's, if you're 3 years out, that's when you need to start that process. Build a management team, document your processes. And then when you're 1 year out, gather all your documents, get again that SDE calculation, and you want to try to make that last year before you're listing for sale, you want to make that your strongest, most profitable year. Now I say that, and like what can be a bit of a red flag is like if all of a sudden the most recent year is just like twice as profitable as every year before, that is going to be a question. And I think a lot of times the reason that sometimes happens is that it's really this tax strategy stuff. That's why we say start doing this 5 years out, so that the last few years are clean, and it's not like, oh, I just stopped billing all of my Amazon purchases to the business in the last year, and that's why we were so much more profitable. You want to avoid that. All right, so if you want to get a sense of how ready are you to sell, we can help with that. You can reach out to us. We'd be happy to help give you kind of a SBA readiness review. The documents that you're really going to need for us to be able to do that is understand the last 3 years of tax returns, calculate your debt service coverage ratio, make sure your lease is transferable. We haven't really talked about that, but the buyer, if the lease of the physical space is important, you want to be talking to that landlord ahead of time and saying, hey, if I have a new buyer, they're going to need to be able to get this lease in place. The lease is going to need to have the option to lease that matches the term of the SBA loan. So if it's a 10-year SBA loan, the landlord's going to need to be willing to lease the space for 10 years. And then, the business can run without you. Revenue is stable or growing, no major legal issues, and no single customer 20-30% of revenue. So if you want to get a free review from me, and I can review your situation and give you some feedback, we have a free SBA seller review. We'll put a link in the description of the video below. You can sign up with an email and give us some information. I'll give you some free feedback. And then we have kind of a optional like next level analysis where you go a bit deeper. and we can actually, have an SBA lender connect you with SBA lenders in our network, and they'll actually put together a SBA pre-qualification letter. And so this means that they've reviewed your business, they reviewed your package, and they can say, hey, if you find a buyer who is qualified and has the down payment and the industry experience and the credit score and those sorts of things, we would be willing to lend based on the cash flow of the business. We'd be willing to lend X. And so you kind of get a pre-qualification of a dollar amount. And that's a good exercise to go through. Just gives you some reality check from a lender perspective. And we'd be happy to help you through that process as well. All right, so that is it. I hope this has been a useful time for you. And thanks for sticking around here to the end. So again, you can reach out, you can email us. Our general support email is support@projectionhub.com, or just reach out to me directly, adam@projectionhub.com. I'd be happy to answer any questions you have. And we've got in the description of the video below, we'll have some links to different resources that we've mentioned or forms to reach out that you can fill out, and we'd be happy to help. So hope this has been helpful. If it has been, please like the video and hit the subscribe button. We're going to be doing more and more seller related content as well. We work with a lot of buyers, but sellers have been reaching out more and more often. We love that. And so make sure to subscribe and be able to see what we come out with next. All right, thanks.